Welcome back to part 2 of the Beginner's Guide to Forex Trading. In this episode, we are laying the foundation you must have before entering the markets. We will break down the major currency pairs, the different types of Forex analysis, how to manage your risk like a professional, and the exact steps to start trading. If you are serious about growing in this game, this is where it starts to click. Let's dive in. Major currency pairs and market hours. So in general, there are 7 major currency pairs in the Forex market, but I have chosen a few of them just for the purpose of illustration. So the most traded currency pair is the Euro USD, followed by GBP USD, followed by USD JPY, and then AUD USD. Amongst the major currency pairs, these are the most traded. Number 2, we will be talking about the market sessions. Market sessions are divided into 4, but sometimes it is broken into 3. Sydney and Tokyo, they are combined in a way to give us Asian session. And then there's London and there's New York. So Sydney and Tokyo will give us the consolidation that we need so that London can do manipulation and start distribution. Later on, New York will either reverse London or will do a continuation. So New York will either reverse London or do a continuation of London. But at times, you will find that Sydney and Tokyo did the distribution. London is likely to accumulate, and then New York will do now a breakout. But in most cases, Sydney, Tokyo, this is where liquidity is engineered. We need to know the best time to trade. So the best time to trade is during the London and New York overlap. But when London opens, there is quite a good number of movement that you can leverage and trade. However, it is not advisable for you to enter the market during the first hour of London open. The reason why you are not advised to enter the market immediately London opens, think of it like a market. So when people are outside the market waiting for the doors of the market to open, what will happen? Immediately the doors are open, people start now scrambling to enter. So this is not the right moment for you to enter with these people because there could be stampedes. So you wait for the market to be opened, give it 1 hour to settle. For example, you can use the London time frame. Normally, 8 a.m. the market will open, London time. So give it 1 hour to at least 9, and then from 9 now, start looking for setups. So you have like 3 hours to look for active setups. So from 9, 10, 11, and 12. At that particular time, you must have found some entry opportunities, even made profit and left the market. New York the same way. When you're trading in New York, you need to understand what time does New York open. So once New York open, get to know that always market will open at 8 a.m. So wait for the New York to open. Give it some time for the manipulation to take place within the first 1 hour or so. And then now from 9:30, start now looking for proper setups because now the market has settled. It is ready to move with clarity. Types of Forex analysis. There are 3 types of Forex analysis that you need to know as a trader. First is the technical analysis. This is pure charts. You need to read the price action and get to see what the market is telling you. And once you understand the technicals, you can trade even without the fundamentals, because you can have the fundamentals, but the technicals will now tell you where to enter, where to exit. Fundamentals will never tell you where the market is going to next. It will give you just overview. So you need to understand the technicals, know the charts, which is pure price action. And some people do use indicators, but personally, I am against the indicators because sometimes they will give you false information. You need to read the price action as it happens. That way, you can make your human judgment, not using the robotic judgment to make decisions. Fundamentals. These are news, interest rates, economic reports, and all that. So, how does fundamentals affect Forex trading, or why do you need the fundamentals? If you remember from my previous video, and if you have not watched the first part of it, I explained clearly on what the fundamentals are and how to read the fundamentals on the Forex Factory. So if you have not watched that video, there's a link somewhere up here. Go watch that video because it will now give you the basics to get to understand this part 2. Having said that, part 1 I explained so well about fundamentals, economic reports, and all that. You need to know the sentiments. What is the sentiment? Sentiment is the market emotion and positioning. For instance, you might find that we are in a very bullish market. But by the time you're opening the charts, the market has started to retrace back to OTE zones. So despite the fact that the market is bullish, due to this sentiment, you can be able to leverage on the pullback leg and earn some few pips before the full retracement happens. Again, I shall be explaining on the charts on how you need to trade these pullback legs, and also once the market reaches the OTE zone, now the sentiment would have told you, look, the pullback has come to exhaustion. Now it is time to continue with the overall trend. The sentiment will tell you where to enter and where to exit. So for a retracement, you will know that if the market has not reached the 50%, the overall retracement level, it means you have some pips to cover, because at least it must get to 50%. And if the retracement has come to exhaustion, you know once you enter, the next target, it is either the internal liquidity that was generated within the RTO leg, which happens like this. Let me show you. Let me use a pen. So for example, we are in a bullish market. You've opened your charts and you find the market is somewhere here. I want you to understand the sentiment part of it. So the overall trend is bullish. If we are going to enter at this level, what is our take profit? Your take profit target must be either somewhere before the overall liquidation happens on this high, or you can aim the final swing. But it is always advisable to take your full TP within the internal liquidity level. The reason why this one is key, sometimes price will come, sweep the internal liquidity, retrace back near to origin, refill the imbalance left down here before it proceeds up to complete the overall target. It is good and it is advisable to aim these low-hanging fruits. If it gives you at least 1 to 3 R, take it and bank your profits. Wait for the second chance to re-enter the market, because the chances are after this liquidity is swept, the market in most cases will retrace back before its continuation. So there is no reason why you should hold your trade past this, yet you know very well once it sweeps, chances are it is starting to go sluggish before it proceeds up. So to avoid these emotions, should I close this trade? Should it hit my, stop loss or what? Bank your profit at this level. Wait for the second chance to re-enter this position if the chance happens to be visible down here. And then now you can aim the weaker swing because you know the sentiments were telling you the market is going up. We go to risk management. Risk management is key because take it as a business. If you're running your businesses, you must think of your risk exposure. Because if you risk too much, it means you might blow your business before you even realize your business would have gone down to ground. It will be crawling, it will be sinking. So once you enter the market as a beginner, I would not ask you to risk 2%. Start with 1% until you're comfortable risking 2%. But as a beginner, just risk 1% of your account. So even if you're trading a 5K account, it doesn't matter. Focus on just 1%. This way, you will not be too emotional. So for example, you've entered a trade. Assume this is the zone you saw the trade. Let me use the first scenario whereby we've seen market retrace this way. It went up. It has come down here. And now you're entering to benefit on this move. So if you found your entry somewhere down here and you risked, let's say 2%, you will be attached to this trade more emotionally than you would have been attached to it if you risked just 1%. So to avoid this emotional attachment to the trades, risk just 1% and say, look, I'm okay losing 1% if my analysis is wrong, and I am okay earning the whatever percentage, be it 3% or 4% or 5%, if I'm right. So I normally advocate for set and forget. So once you've set, put your stop loss, put your take profit, normally the liquidity before the final swing, the internal liquidity before the final swing. If it gives you the RR you anticipate, for me, I say you must trade between 1 to 2 or 1 to 3 minimum. Don't go for 1 to 1. Don't go for 1 to 0.5. I shall delve into this further and show you what I mean by that when it comes to charting and all that. So if you risk 1%, put your stop loss, put your take profit, ensure your take profit is at a zone that has liquidity. Do not put your take profit where there is no liquidity waiting to be swept. Once you know exactly why the market is behaving the way it is behaving, then you time it. You know after now, the retracement, it is gonna go up, and before it retraces back, it must aim this draw on liquidity, assuming the market had changed. There must be supply up here. So for this supply to be activated, there must be liquidity prior to supply. So this liquidity must get attacked, and then price will tap to supply, and then it will drop. So by the time the price is going to tap into supply, your take profit would have been activated, and you've banked your profit. You're waiting for the second re-entry if there is. But aiming the overall swing, sometimes it is risky because sometimes these highs are not swept, but the liquidity inside here have the chances to be swept 95% most of the time. Number 4, avoid emotional and revenge trading. If you risked 1% and you are aiming the overall take profit, unfortunately, it did not happen. Price came up here. Maybe you did not notice the change of character had happened. It happens sometime. And then the market has tapped into supply. It did not sweep the final liquidity. It has crushed your stop loss. Do not be emotional that now you want to start selling the market immediately. Stay calm. Observe what the market is doing. It could be there was a stronger demand down here that the market wants to tap into before it rallies up to sweep the overall liquidity up here. So, if by you being taken out when your stop loss was attacked down here, and then all of a sudden you've changed your buyers, now you want to sell the market and aim somewhere down here to recover what you have lost. Think of what will happen. The market will get down here, respect this level. This is the invalidation level. It will respect this level. It will not go to your take profit. It will now rally up to continue with the overall trend. You would have lost because you did not put your take profit where you are to be filled, and you will lose in this second scenario because you wanted to revenge. You want to recover whatever you have lost almost immediately. You will end up losing more. Emotionally, you never did any analysis. You just saw, okay, my stop loss has been run over, so I need to recover these losses as fast as possible. So without a second thought, you enter without even calculating the lot size. You enter and you put, I don't know, your stop loss somewhere here. You're risking too much now because you entered emotionally. You had no logic reason to enter this market. The market gets down here, taps into demand, goes up, sweeps your stop loss again. You end up losing around 3% or 4%, whereby you would have just lost 1%. Stay calm, wait and see what the market does next, and maybe after second analysis, you would have captured the market down here and move up with it clearly. Steps to start Forex trading. Also, this is just a recap from what I did on the part 1. So number 1, you need to learn the basics. Study. There are a lot of free resources on YouTube. You can log on to Baby Pips, www.babypips.com. After you have gotten some trainings, now you need to open a demo account. A demo account will give you exposure to do your trial and error without risking your hard-earned money. Within this demo account, you will now practice on how to calculate lot size, enter limit orders, practice to put your take profit and stop losses, and get to know how the market works. After you have blown several accounts of demo, you are going to learn from the mistakes. If you place a limit order and it was not activated, you will come back and study the market and ask yourself, why did my market not trigger this limit order? You will understand. So the second time you're going to do the same, you will be smarter than before. If by any chance the market triggered your order, then it gives you a reason to go back and ask, I did this analysis, the market came to my entry point, it activated my order, but it struggled to proceed to where I thought it would go. Why was I wrong in this? So get back to the technicals, revise, and if you're not understanding, there are free resources again. Try to research on the things that you are not understanding. There are a lot of people teaching the same things online for free. And if you find some difficulties, maybe you are not getting it from the YouTube or these other free resources, find a mentor. Get someone you believe in, someone you followed, you've liked their content, you've seen how they train. This is the thing that you need. If they are speaking your language, I think it is time you contact them and ask them, hey, I'm stuck. I'm trying to do this, but I'm lost. So once you talk to this mentor, get to understand if their trading style is what you would like to emulate. If their trading style is not what you like, do not waste your money paying for their mentorship courses. Keep on refining your strategies up until you see something that works. At some point, it will click. You need to set up a trading platform. I would advise you start with MT5. Before you go to MT5, again, go to the first video that I uploaded, the first part of this, whereby I explain a lot about TradingView. Because before you start entering your trades, you must have analyzed them on the TradingView. You must understand how to use the TradingView before you even go to MT5. You are going to MT5 to do execution. MT5 can offer you a mobile version and a computer version. I'd suggest you have both if possible. But most importantly, once you have the TradingView on the laptop or your computer, you can have MT5 on your mobile phone and it will be fine. Because once you calculate your lot size, you know the price you want to exit at, because there are two exits I explain on my part 1. The next thing you would want to do is to create your simple trading strategy. This strategy will guide you like a roadmap. Think of it as someone who wants to travel to some place and you do not know when you reach at a certain corner what you're supposed to do, or when you reach at a crossroad, you do not know whether to turn right, left, or proceed or take a U-turn. The strategy will clearly guide you as you proceed looking for entries and analyzing the charts. In the market, there are so many strategies that are out there, and as beginners, I know 99% of you are going to be introduced to the simple strategy of support and resistance, whereby people are going to tell you, you mark 2 areas. If the price is going to touch here, I don't know how many times, you need to look for sales. And if it's going to touch down here, I don't know how many times you're going to look for buys. So you are going to stay awake in the middle of the night, trying to wait for this bullish engulfing candle from a random point where the price is bouncing off, hoping that luck will be on your way so that you can put your entry here, I don't know, stop loss somewhere down here, and then you want to target, take profit up here. So avoid such strategies because they are so ambiguous. You need something that has clarity. And today I want to welcome you to the supply and demand coupled up with the SMC concept. You are going to know why is the market dropping once it gets to this level. Probably this must be supply, and not probably, but you have to identify the real supply using the strategy itself. You're not going to draw a random zone whereby prices are bouncing off and you're going to work based on luck that maybe, just maybe, I am going to win this time round. You do not have to do that. If you are in this channel, you are better than that. You are here because you are tired of losing and you are tired of watching numerous videos that have not turned your life to any positivity. All right. Having said that, you need to backtest your strategy. After you have learned supply and demand strategy, you need to put it into practice and see how it works. Okay, so after you've learned how it works, now it is time you start trading with small live account. This small live account, it means you're going to deposit something small to your preferred broker, of which I said I am not here to promote any. So at your own time, find out. But if you need me to give you a recommendation, I will do that. Just DM me, but I'm not here to advertise any. I am not affiliated with any brokerage. I just use whatever I use and I will not mention it. Once you start with your small live account, there's one thing I need to tell you. It is the bitter truth that 100% of your first installment to this broker, 100%, trust you me, the chances are you're not going to make any profit. You're not going to make any first withdrawal from this amount that you're going to deposit. Why? This is the amount that you're going to deposit to try and make as many mistakes as possible. So this is where your emotions are going to be tested. This is where your entry criteria is going to be tested. So before you really develop that thick skin, trust you me, the small amount you entered must have sunk. So don't commit suicide thereafter if this money is going to sink. I've given you a warning. Deposit something small that you can afford to lose, because in the long run you want to be a better person than you. You cannot get better if there is no pain. All right. That brings us to the end of part 2 of the beginner's guide to Forex trading. Part 3 is on the way, so make sure you subscribe to this channel, like the video, and share it with someone who's serious about learning Forex. Your support helps me keep delivering value. Got a topic you'd love me to cover next? Drop it in the comment below. I'm building this series around your questions and interests. Thanks for watching. Let's level up together. See you in the next one.